when people talk about investing and they talk about companies, you'll often hear people talking about valuation. You'll often hear them talking about growth prospects. You'll often hear them talking about the mergers and acquisitions strategy. I mean, these are all things that fundamental investors talk about and think about. What that really comes down to, what all three of those really come down to is leadership and company culture. At least in my mind, because if you have a leadership that is very good at allocating capital, then you're going to have a better mergers and acquisition strategy. If you've got a leadership that is really smart about finding new opportunities for growth and then scaling them, then you're going to have hopefully great growth opportunities and hopefully good stability for the company. And so for the person, Michael Pearson, who's been so key to so many investing theses around Valeant, to leave and to have apparently at least potentially contributed to a lot of these internal issues, that really calls into question that investing thesis.
Yeah, I mean, when things were great, right? Mm-hmm. And now things are not great. And of course, he's being held accountable for that. The board is going to find a new CEO and get that board is going to put someone new in place. And hopefully they'll be able to kind of get their arms around, what needs to happen to right the ship, if you will. But the challenges are big. I mean, whoever mm-hmm. comes in has been saddled with a mountainous level of debt because Pearson was so acquisitive. Mm-hmm. And, one of the other things we should always remind investors of is that, there are two ways that companies report, their financials. They report them on a GAAP basis and they report them on a non-GAAP basis. And a non-GAAP or adjusted basis, oftentimes in situations where companies are very acquisitive, may not be the best way to look at the company because it's very hard to figure out all of the moving pieces and how these acquisitions are flowing through to the bottom line. If you look at a GAAP basis, Valeant's been losing money. If you look at it on a non-GAAP basis, they're making money. So that's something for investors to keep in mind with highly acquisitive companies, just to make sure that you're considering both the GAAP and the non-GAAP and taking the non-GAAP results with a little bit of a grain of salt.
Yeah, or at least understanding how they came to it, right? So when you think about how Valeant or another company calculates it, I mean, usually adjusted earnings they're zeroing out things like one-time expenses, which are often acquisition expenses. But really the key thing there is just to know the fine print and to know what they're zeroing out, why they're zeroing it out, and sort of building that into your own sort of thought process around the company. And that's always a little bit of a struggle, I think, with everything, because often adjusted earnings, do give you kind of a better sense of the company from the people who know it best. At the same time, it does create this possibility that you're getting two different stories and you really need to kind of reconcile them together.
I absolutely agree with that. And that's why, again, with acquisition-friendly companies, especially, you and I talked a little bit about the onset about trying to figure out, how you should think about Valeant as we go forward. Mm-hmm. And, I think that, as investors, we have to temper our enthusiasm. I mean, this speaks right to what we were just talking about with. I mean, if you look at it on a non-GAAP basis, shares are undeniably cheap. Mm-hmm. Even though they've revised down their guidance and now think that they're only going to make, I think it's between $9.50 and $10.50 in earnings per share on an adjusted basis in 2016. Well, now you're talking about a P ratio on a forward basis like less than 3, right? So the first thing you think of is, wow, screaming bargain, right?
Right.
But you really should probably look more or think more about this company as a potential turnaround candidate rather than, say, a candidate that's an investment that's already in its turnaround.
Yeah, I think that's a very good point. I mean, really, in a lot of ways, they've kind of hit, with the departure of leadership and with all these revelations, they're certainly in a rough spot right now. And what'll be interesting to see is what they do from here. Of course, the first step of that is getting that 10K filed, which they need to do by April 29th, I want to say.
Yeah, they plan on doing it by April 29th. This is really important because, they owe $30.9 billion, and they only got $1.4 billion bucks on the books. So if debt holders say, hey, listen, you didn't file, which means you broke a covenant on these loans, and we're going to now say that you're in default, well, then there could be quite a cash crunch that develops at the company because of that. So yeah, you got to get those things filed, and they got to be right the first time.